It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Another top pick here from Ryan Irvine is Sylogist, and this stock has done exceedingly well. You're looking at the ticker SYZ, and this one's on the venture.
Yeah, we've owned it since around the $7 range. It's done tremendously well for us. It's really just a good, solid business. And the balance sheet, like we keep talking about balance sheets today, $30 million in cash in the bank. It's like $1.50 per share of the company. There's no debt here. So this is a company, if there is a downturn, they will go out and make acquisitions in their market. What do? They provide software, so back-end accounting type software, enterprise planning software for nonprofit organizations, government organizations, and K-12 schools. So good, solid business. It's a SaaS model. About 70% of their business is software as a service, so recurring type business, which we like. It gives us predictability going forward. It's upped its dividends, I think, each year for the past 5 or 6 years now. We love that it pays a dividend. It's yielding about 3%. They just this month upped it another 18%. So, it's upping its dividend every year. Some years we've got a special dividend in it. We think next year they may take a little bit of pause in terms of growth, but that can change in a second with a good, solid acquisition. They made a good, solid acquisition of a K-12 software company just this time last year, and that added to growth over the course of this past year. We saw really strong growth in the business. I think that it'll earn 85 cents adjusted earnings or adjusted EBITDA this year. Right now it trades at a discount to what we think is fair value, around $16. So we think there's still a lift in the shares. You're getting paid that dividend. The company at any time could make an acquisition that would be accretive. So that's what we like. We like a business that has that can profit in a downturn, profit right now. And management has done a good job with this business. They own a significant amount of shares too. So we love to see them pulling on the same rope as us.
My one follow-up would be that it looks like it's not that liquid with average volume of 33,000. Is that
a very good
potential problem for a retail investor?
It can be, but we're looking 2 to 3 years out most often. So if you put a limit order in, if we put a buyout on this company, we always say here's a limit. Say you're buying between 13 and 13.25. Stick that limit order in, have it in for a week even, and get filled over that time. Often you'll get filled within a day, right? But if you're trying to buy a huge position, you need to have that limit order in there, and it can be difficult. So it's not for every investor because of the lack of liquidity. But we believe, and we've seen this happen with these type of companies over time, the more as more people start to see the great cash flow, the earnings coming out, the more liquid it can become. The other thing is, companies like this with cash-rich balance sheets, cash and cash flowing positive, and trade at reasonable valuations, they can get bought out. Now, we don't buy companies just because we think they're going to get bought out, but it can be a nice way to cash out on a company, if you've built a position over time, and we've had that happen a number of times.